everyone. Thank you for joining our investor education today. I'm Kat Delgadillo here to co-host our event with our CEO, Hall Martin. We'll be giving you a little more information about um, our event and what we do.
Great, Kat. Thanks for joining us, everybody, today. We have another great presentation from our companies, as well as we have special guest Jim Mills, and we also have a short presentation on term sheets and deal terms that you'll find helpful in your startup investing. I want to thank you guys for joining us today. And with that, let's learn more about 10 Capital. For those who are not familiar, we help startups and investors connect for funding. That's our main goal. And this is one of our events. We'll talk about more in a moment. Next slide, please. And so at heart, what we do is we take companies that are in the growth phase and we showcase them to our investors. We have angels, venture capital, family offices, and high net worth in the program that are looking at these deals. And we're going through the process of pitching online, in person. We have roadshow events around the country: Austin, Dallas, Bay Area, Houston, LA, New York, DC, etc. And you get to spend a day with the investors in that process. We also do dinner events, and we also do follow-up online events such as deep dives, investor follow-up meetings, as well as thought leader events as well. So in short, we're putting together all the events. It's a very structured approach, and it saves people time and money for going through our program. Next slide. So these are the different groups we help. At heart, what we do is we form capital for early stage investing. We help high net worth start family offices because they fund emerging managers. We help VC funds find limited partners, mostly family offices. We run a dinner event series around our roadshow events that we bring the two together to network them. And then we also help angel groups find members. We find a lot of individual angels will do better as a part of a group than by themselves, given the time it takes to diligence a deal and then find the deals and so forth. So we're working with many angel groups, VC funds, and family offices to form capital for the early stage. And you see a list at the very bottom of the different groups we work with Keiretsu, New Mexico Angels, Beyond Angels, Houston Angel Network, and many others we've been working with. Next slide. So we have several online events. Today we're in the investor education session. It's meant for investors, but startups are welcome as well. We also have a family office roundtable, a 2-hour session where the content is geared toward family offices and what they're looking to do. We find there's an emergence of family offices in the virtual space. Used to be you had to have full-time people in your office. Today, most people don't even have an office anymore, and they're now moving online and going remote and virtual. And they tend to be tech-driven, and they tend to be very active in early stage investing as well. We also have the quick pitch. This is for our tech companies. We have the panel of investors and then investors in the audience, and everyone gets 10 minutes to pitch, 5 minutes of Q&A, and we give them feedback as well as we answer. They ask questions about the deal. And finally, we have Life Science Syndicate. Half our deals are in the life science space, and we give them the opportunity to pitch and to our investors. And then if you want to learn more about our events, just go to 10capital.group, click on the events button, and you see all the events that we have coming up. So next slide. So if you're a startup and you're interested in raising funding, take a picture of that QR code and fill out the form and send it to us, and we'll be glad to have a discussion with you to see if this program is a good fit for your fundraise. We work with companies that are on the growth track and looking forward to talking with you about your deal. Let's go to the next slide. We also have a chat bot. We're actually expanding this to do diligence reports and more with a private LLM. But basically, we write a startup funding espresso. These are micro blog posts where 300-word posts where in the time it takes to drink an espresso, you can learn something about startup investing and funding. So let's hear more about how the chat bot works.
Hi there. I'd like to introduce myself. My name is Ava, your personal AI venture assistant. I'm your new best friend in the world of investing in startups, the 10 Capital AI chatbot. I'm here to make your journey through the startup ecosystem easier, faster, and a lot more fun. Need help finding your next big investment? Or maybe you're a founder looking for fundraising tips? I've got you covered. I pull all my knowledge from over 500 blogs, countless podcasts, and even some nifty calculators, like the How Fundable Is Your Startup tool, to give you the answers you need. So how do I work? Easy. You simply go to where I live on startupfundingespresso.com and look for me in the bottom right. As soon as I appear, go ahead and click on me to let me know you're here. And then there you go. All your questions answered at your fingertips. Whether you're into health tech, biotech, life sciences, or any of the other exciting fields out there, I'm equipped to help you navigate the trends, challenges, and opportunities in each one. Got a question? Just ask. And guess what? I even pull insights from the 10 Capital Network podcast on Investor Connect. It's packed with expert advice, success stories, and more, all designed to help you succeed in the venture capital world. So what are you waiting for? Let's chat. I'm here 24/7 to help you find the right answers, connect with great opportunities, and make the most out of your investments. See you on startupfundingespresso.com.
Great. And so, like I say, we're expanding that program to actually build diligence reports for our companies. You find AI is a great tool for that. We have a private LLM that will keep your data private and secret. So if you're interested in learning more about that, please let us know. Glad to talk with you about it. So with that, let's go ahead and kick off to our first presenter today. We have Ticket Rewards, Jason Sheets. Let's go ahead. Each one will get 10 minutes to pitch, 5 minutes of Q&A. For those in the audience, please put your questions in the chat box and we'll read them out. And Jason, go ahead and kick off whenever you're ready. And then we'll come back and talk to Jim Mills here in a little bit, who will also be on the panel asking questions and giving feedback. And we see your slides.
Great. Thank you, Hall. I'm Jason Sheets of Ticket Rewards, CEO and founder. We are your Uber connected company in live entertainment, and we've created something called Live Entertainment as a Service. Just to give you an idea who we are a very large ticket operation company in which we have inventory directly from presenters, promoters, sports teams, as well as access to the secondary market of acquiring inventory. We work with very large brands. These are current clients of ours: HBO Max, Celebrity Cruises, Hearst, and a number of different newspapers. Basically what we do, we are their loyalty program in which we're enhancing their programs by giving them a live experience with either access at prices that are lower than market, or access to tickets that are preferred seating. Consumers then associate to the brands that are getting it and having this great experience. They're going to the experience that they have, and then there's an emotional connection back to the brand itself, which helps them have higher engagement and retention over the longest term, and it reduces churn. The reason why we bring up the word churn is because it is a very big topic right now in the live in the streaming service space and subscription space. This is one of our partners in HBO Max that at Warner Brothers, the biggest killer in the business is churn. And working with them, they're actually already seeing an increase in retention based on the program that we've given to them. And I'll highlight that in a second. So over the past nearly 2 years now, we had a growing business of just basically giving a deals platform. And we saw a big opportunity in how we can actually engage in the loyalty space and helping to engage and retain customers for enterprise brands and maximize their revenue while retaining customers at the same time. Live entertainment is untapped loyalty program still. You might have those experiences for American Express of getting access to certain types of shows, but actually getting it on a very large scale, it's actually high cost to get in this space. And the interesting thing, there's tickets that are bountiful across the board. Our solution is basically we have a mobile first co-branded or white label redemption platform of over 35,000 events. That 3,000 of those events are often curated with offers from anything from Andre Bocelli to ZZ Top, from your Yankees to your Red Sox, to your Broadway show, whether it's a Hamilton or the latest best musical in The Outsiders. We have over $500 million of consigned inventory. My word's consigned at preferred rates. So we actually have the ability to take inventory, hold it for a while, resell it with a margin, and actually not have to pay for it until we sell it. We have over $1 billion of a marketplace that we can tap into as well, with over 35,000 events. The platform itself drives high engagement, retention, and brand loyalty. And it's in a space that is very large already in the live entertainment space. The TAM is very large, but actually getting access to tickets is the biggest thing. And that's what we are very good at. We have the relationships directly with the ticket holders themselves. We are industry agnostic as well as we're ticketing agnostic. So we work with everybody from Ticketmaster to the AXS to even your small platforms with that I can name many for. Interesting though is we're in this space, the loyalty and rewards platform space is even larger in the services space for this. Current clients that we work with, I highlighted before. I'll give you some examples. We work with United Mileage Plus and basically giving them all of their offers, and it's growing rapidly because it was a new client at the end of 2024. HBO Max, we reach about half of their audience currently as they're doing a pilot program and now expanding across it. We are a major provider for Hearst, number of different newspapers. And then there's companies that are like Toll Perks in the Dallas area that have over 1 million members that we give access to our platform. We also actually have access to other marketplaces that we actually do about $2 million worth of revenue on a yearly basis. Our active platform, thank you, sweetheart. Sorry, my daughter just gave me food on the side. Apologies, everybody. We have a very, very big pipeline, but here's the biggest thing: is I'm going to circle this right here. Is Lyft is a big opportunity for us, and we just got a phone call yesterday highlighting that they're going to be starting with us in August, September. It is a reoccurring revenue model of about $200,000 a month. In which we both get a service fee as well as when people redeem, we make a little bit of margin as well. We also just launched with Go-To Foods with their pilot program, and we'll be launching with 1-800-Flowers recently as well. So we have 3 of these partnerships in our pipeline that are starting to go already. As an example of when we do our tests, Hearst started with us with 1 email. They're now up to 4 emails a month with their over 200,000 consumers that we're reaching. United Mileage Plus started with a program just in October of 2024, and now they've decided to move forward with us for full 2025 on their exclusive platform. There's a number of different ways we make money, but one is to know that we have a very specific model that no one can replicate because of the way we do our business. We actually can give $25 worth of credit per month to members and up to $300 a year of a benefit to companies on our platform. As I've already highlighted, Hearst actually uses our platform right now, and they're already seeing 50% of the people who are using the platform were people they thought were going to likely to unsubscribe to their service. It's a customizable redemption platform that we own ourselves. And these are things that are currently working in the market. And then we have an inventory management system that allows us to have our own inventory, have APIs to other inventory in the marketplace, and then easily expandable for other products like theme parks and travel later in our product. Our technology looks like this. This is customizable as well. So this is the HBO Max model. It's it basically loads all of the products we have in a very quick fashion and easy to navigate. 4 models that we work on. So it creates the ability for us to make multiple ways of making money. A subscription model, basically 3 cents per member per month. And then if it gets to a very large scale, we usually come with a number that comes down to about a penny a month per member. But these contracts are in 6 figures on a monthly basis. We have a curated platform for deals. Basically, we work with a number of different newspapers that allows us to make 20 to 45% margin on ticket sales, even though these some of these offers are about 40 to 50% off. We have an incentive card business that a lot of gift card companies are starting to use with our gift cards. Buy $25 worth of a gift card, get $25 worth of tickets, and they leverage that because it's cheaper for them to do versus actually discounting their cards. And we've started doing advertising as well, working with Darden restaurants. They are actually leveraging our platform as a way to reach people as they're going to events. We right off the bat, we're making money just because of the relationships we had. In 2024, we did about $3 $3 million worth of revenue and is currently growing at a quick pace. We are investing heavily into the marketplace because the one reason that we know that we need to get is more people in the sales and marketing space because our sales cycle is longer than we would expect. With the Lyft deal that we have, we do think it'll be quicker as they come on board. We saw that about 4 or 5 of our partners who joined us is because they saw a deal we did with Max. We're going to see 100% year-over-year growth in the coming years. And then the good thing is that the margin of the business that we're doing is going from a 30% to about a 50% margin due to the service fee agreements that we're doing that are about 80% margins. Our team is both highly educated in the ticketing space. The ticketing space is very much relationship driven. We basically know the people in the space who owns the tickets and owns the technology to do so, which allows us to actually give different inventory than most people can. We have a number of people who have actually started in startups who have then been acquired, and everything from the travel space to working in the ticketing space with Broadway.com with me and myself and Paul. Cole's actually done a number of things in getting after partnerships with our Lyft deal. Just to give you an idea, we went up to the CEO. The CEO is actually the person who is we are working with directly to get this done. Our investment we're looking for is $2 million. We've actually raised about 320 already so far with a $10 million cap. On a safe note, our biggest thing is we have to invest in people and as well as the marketing side is going to conferences over the next year. We do believe like just making this initial investment up front will lead to very big contracts coming down the pipeline. The good thing is that we're already looking at some exit strategies already. We do believe we've been acquired in the next 3 to 5 years. We have actually, when we went out to one of our partners talking about fundraising, they were interested in potentially even acquiring a large chunk of the company already. And we're looking at an active potential acquirer. We're looking at it, but at the same time, we're seeing that there's more opportunity for us in fundraising as this opportunity gets larger. The potential acquirers, EBG is an entertainment benefits group that was actually purchased by CAA, and they're looking for additional ways in which they can add to their bottom line as well. They work in the employee benefit space, where we're working in the consumer direct space. AEG is a ticketing company who's looking to compete against Live Nation. And then Blackhawk is a gift card company, basically, is putting all the gift cards up in your grocery stores, your Best Buys. Hearst, we pitched to their venture fund. They said that as we expand, they really like the model to come back for them as a possible acquiring company. And that's it for us. If you have any questions, I'd love to take them.
Great presentation, Jason. Our first question comes from the audience. Is the consignment inventory exclusive?
Much of it is, yes. So as an example with Promoter, we'll actually work with a promoter who will assign those seats to us, and then we will highlight them down each of our channels as being exclusive inventory for them. We do work with some aggregators in the sense of theaters in the US, like on Broadway, where we're actually taking active inventory that's been given to us as a reduced rate. And then on a nationwide basis, we work actively with about 250 different venues and actually getting inventory about 6 months before a show starts. That's mostly like your family shows, your Broadway shows, and then some concert promoters.
Great. We have Jim Mills on our panel today. Jim, what's your first question?
Thanks, Paul. Jason, great presentation. I love what you're doing here. I come out of an industry that used something similar to this. I feel like I got a little bit of a feel for it. You had mentioned about churn, and I know how important that is to a lot of the people you're dealing with. But I noticed in the way that you're monetizing through the companies you're working with, do you have any bounties? Like if you lower churn, are you able to make more margin? And if not, I would look there. But what are you doing for that? Anything?
Sure. So it's a great question. There's a number of different ways that we look into client for what their needs are. we've approached like if we do really well, you should pay us more type of model. But what we're mostly looking for is keeping them for a long term. So if we can get them on a basis of understanding of using us over and over and over again and getting us into their cycle, what we found that the users themselves start using us more often, because when you do redeem our 25s, we actually make money. And then we actually acquire customers this way as well, because we actually can repurpose marketing to them and later on. So our job right now is to get as much distribution as possible. In the newspaper space, we've actually pitched that you can use our platform for free and then use the marketing message of $300 as your benefit. And then if we bring a new customer in, they pay us a bounty right away. So there's on an activation basis for working with Max, who brings on millions of people in a quarter. We're looking actually as a way for them to use this as a win back promotion, in which we're getting paid per that bounty, which might be $1 per bounty. In the tests we did with them initially, 15% of the time we were beating, or 15% more than if they were discounting their own product. We were beating it by 15%. So by investing maybe even $1 for a new consumer or an old consumer to get back on, I mean, there's a 7-figure opportunity for us to gain there.
Yeah, I think you're right. I don't know a lot of the companies you're dealing with specifically in their finances, but generally those recurring revenue models, it's a 12 to 13 to 14 month break even for them. So if they keep somebody on past that period, it's wildly profitable to them. Have you thought about getting into the wireless industry?
Yeah, so we're actually speaking with Verizon, Frontier Communications, who's owned by Verizon right now, also AT&T. T-Mobile Tuesdays, I think everyone possibly knows that. The model that they've created currently is basically a pay-for model. We are seeing if there's a way we can get in that area as well. There's a lot of different space. So the magazine space, the subscription space, we're talking to Hearst right now, as well as there's Gannett, Lee, and McClatchy in the newspaper space. We're talking at the headquarter level about implementing this on a large scale within their newspapers. So there are a number of different revenue or subscription models that we're looking at.
That's perfect. Thank you, Jason. I appreciate your presentation. Well done.
Yep, thank you.
Great. And that's the end of our 15 minutes. Thanks so much, Jason. And we'll now go to our next presenter. We have up with us next Synaptica Therapeutics. Ken Mariage, if you could launch and kick off when you're ready.
Hey, thanks for having me. Appreciate it. I'm going to go through this pretty fast. And of course, if there's further interest, I'm happy to answer any questions at the end or in a follow-up call. So I'm Ken Mariage. I'm the CEO, here to tell you about this exciting Alzheimer's breakthrough therapy. It's backed by Sony and Time Zero Capital. It's a powerful take on an existing brain stimulation technology, which significantly slows down disease progression in this holy grail of medicine. The results are absolutely unprecedented. We have 2 phase 2s done now, clinical trials, randomized controlled at 6 months and 12 months, showing it's more effective than any drug with virtually no side effects. So all of us know someone who's experienced this hideous disease. It engulfs the lives of families in a way no other terminal disease does, and I've personally lost 2 grandparents to Alzheimer's. And isn't Alzheimer's a graveyard of failures, you might ask? Well, the problem is the industry has been obsessively focused on amyloid, the usual suspect. So targeting amyloid is like cleaning up the ashes after the house is burned down. We need to look at other so-called suspects, some of which are hiding in plain sight. We're focused upstream. We're targeting the synapses themselves. We use magnetically induced electrical stimulation to induce neuroplasticity. Now, simply put, when we stimulate neurons, they strengthen. The question is, can we get enough neuroplasticity in the right areas of the brain to slow down this freight train of disease? Transcranial magnetic stimulation, or TMS, is a safe, established, powerful, but painless technology. It's been used successfully in depression since 2008. But until now, it's really been shooting in the dark. with no way to confirm which brain network we're actually hitting with this technology. Now, our patented technology combines TMS with EEG in real time, so that for the first time, we can confirm if we've hit the right target, and that changes everything. In our case, the target is the entire default mode network. That is the brain network where memories are formed, which is most affected by Alzheimer's disease. Our scientific co-founders are supported by all the right institutions, including by the Bill Gates-backed ADDF, which has funded them 5 times previously. Emiliano's over at Harvard, and Giacomo's at the Santa Lucia Foundation and at the University of Ferrara in Rome. Here are the results from our latest 1-year phase 2 randomized controlled clinical trial presented October 31st at the very large CTAD conference, the biggest in the world for Alzheimer's trials. Here's Giacomo on stage unveiling the results. The 1-year trial was a complete success on every single measure. When was the last time you heard that about an Alzheimer's therapy? We significantly slowed the disease in all 3 domains. We preserved cognition, we preserved function, and we also had an effect on behavioral disturbances related to Alzheimer's. That's the trifecta. No drug has ever done this. On activities of daily living in particular, the real group, that is the stimulated group, barely lost any function over a year period, whereas unfortunately the placebo arm lost about over 10% of their function. So the worst that could happen with our therapy is a mild headache, which resolves spontaneously in about 10% of patients. That is the worst that could happen to you, unlike the drugs, which cause all kinds of serious brain hemorrhage and brain bleeding that could kill you in the case of the drugs. We don't have any of those problems. We won FDA breakthrough designation, we're published in prestigious peer-reviewed journals, and now we're getting great press now that these results have been presented from the stage at a major conference. Each patient gets calibrated to ensure we're stimulating in exactly the right spot. They don't feel a thing. All they need is a simple finger prick blood test and an MRI. That's all they need. The system actually exists. This is not a mock-up. It's already approved in depression. We've simply repurposed it on a new target in the brain and added personalization with TMS EEG. Now, personalization and precision are critical. It turns out that where you stimulate in the brain is really critical to getting these great results. And we own freedom to operate on that TMS EEG personalization technology. We have our patents granted that cover that personalization technology, and they apply to any brain disease. We've done our homework, we've done our FTO, and it's clean. We also, just a few weeks ago, got our new reimbursement codes. We are well on the pathway to having Medicare pay for this, up to $22,000 per patient per year. So our business model is to sell the entire system and to charge per use. We're going to sell it to neurologists. Each system makes us about $300,000 per system per year, and that's just from 40 patients. There are 2.2 million patients in our sweet spot and 4.8 million on label. So do the math on 290,000, 40 patients, 4.8 million. The numbers get very big very fast. Now, neurologists stand to make $366 per session based on those new reimbursement codes. That means $400,000 per system per year from just 40 patients. And some see hundreds of patients, if not thousands, in the case of major institutions. Now, keep in mind, neurologists don't make any money on the Alzheimer's drugs. In fact, some of them actually lose money on the Alzheimer's drugs. So this is an enormous new profit center for neurologists that is a very strong incentive to adopt our therapy and stick with it. We have a thoughtful go-to-market plan, which puts us on a conservative pathway to $900 million in sales by year 7. The larger recurring revenue piece of that has drug-like margins north of 90%. In the hands of a Boston Scientific, they could easily do $2.2 billion by year 7. Now, how do I know what Boston Scientific could do with this therapy? Well, I was the head of strategy for Boston Scientific's billion-dollar neuromodulation division for nearly a decade, and that's the very division that would acquire this therapy. Lisa is the only person I'd really point out, given limited time. She's actually run a phase 3 in Alzheimer's before with a deep brain stimulator. And so no one on the planet is more prepared to run our phase 3 for this therapy than Lisa. We also have some of the biggest names in the world from Alzheimer's on our SAB. Luminaries like Jeff Cummings and Giovanni Frazzoni are a who's who of Alzheimer's KOLs. We also have some great commercial advisors. This convertible note funds a phase 2 study, which has just started, which will expand us into early AD. Now, if we're successful, it'll double the LTV per patient. The note converts into the Series A, which funds the pivotal study, which could put us on the market by 2029. However, recent conversations with the FDA could put us on the market as early as 2028. Think about what that would mean to have a safe, effective therapy like this on the market in just 3 years. And when we get there, easily Boston Scientific could swoop in. Look at the acquisitions they've done just in the neuromodulation space, including Axonics for $3.7 billion just last year. Medtronic could also swoop in and buy us, or Abbott. We were just talking to LivaNova. I'm also in conversations with GE. Their CFO actually hired me at Baxter 20 years ago. So any of these strategics could acquire us. We could also go public. NovoCure is a great comp. They IPO'd for 1.8 billion and then rose to over 20 billion. At a 55 mil val cap on our convertible note, it's not hard to see the enormous potentials for return here possible. And NovoCure is for glioblastoma, by the way. Alzheimer's is a 400 times bigger market than glioblastoma. There's about 3 million left in our convertible note. We've got 40 investors into the note and counting, including Dinesh Morjani of Time Zero Capital. We're offering warrant coverage if people get their deal in by March 15th. I know that's not a lot of time, but we're willing to work with people. So that funds the phase 2 program, which again could double our LTV. So in summary, it's an exciting breakthrough in this holy grail of medicine. We have phenomenal results from 2 completed phase 2 trials and a third one on the way. It's a patented moneymaker for neurologists. It's generating recurring revenue with margins north of 90%, which could be in the market by 2028. We may even be able to offer early access to certain VIP patients under the right clinical trial conditions. In summary, this is precision medicine at the connectome level. And I'd love to take questions and tell you more about it if there's interest.
Great presentation, Kim. Jim, what's your first question?
Ken, great. I mean, amazing. I mean, probably everybody on this line has been touched by Alzheimer's in one way or another. So thank you for working so hard. Hey, first question, just did you say this is effective on glioblastoma as well?
No, I was just using that as a comp. Yeah.
Okay.
I mean, if NovoCure can go public for 1.8 billion, addressing glioblastoma, which is another fatal brain disease, I was using that as an analogy to what we could do, except Alzheimer's is 400 times bigger market.
Yeah, I thought that's what you said. I just want to make sure because that's another thing on my radar. Hey, could you talk a little bit about your pipeline? Where do you expect to get to in the speed and to get the valuations that you're talking about?
Okay, so interestingly, timely question. Just last week, we published new data with our Gen 2 technology. So we're already on to Gen 2. When I was at Boston Scientific, you would always want to plan a cadence of new releases, right? Every 2 to 3 years, we'd have a nice cadence of new releases to get us in front of physicians and upgrade them. Turns out we already have one study done using our Gen 2 technology, which combines another stimulation modality on top of this. I don't want to confuse people, but the point is we have an upgrade already that we could offer patients and providers once we're on the market. So we're already thinking about these upgrades to our hardware. And then as far as indication expansion, we now have memory enhancement data for healthy individuals, which is really interesting. Of course, we're focused on Alzheimer's. That's a holy grail, but the memory enhancement data for healthy individuals is enormous. That was just published last week. I can send you the publication or we can put it in the chat. So that's a cash pay market that could have, billion-dollar potential just by itself. This could also be used in stroke, TBI, neuropsychiatric indications. I have a whole slide on new indications for which there's lots of data that TMS is effective. When you bring our personalization to those indications, you can make them much more effective because, again, as I say, what you stimulate in the brain, where you target really matters, and our technology allows you to confirm you're hitting the right targets.
That's amazing. On behalf of all of us on the call, we wish you the best of luck with this technology.
Thank you, Jay. The world needs this.
Yeah, we do for sure. Thank you, Ken. I appreciate your answer.
Sure.
So, Ken, the next question is, how do you plan to drive adoption for it? It's a great product, great business case, but what's the go-to-market there?
Well, I can give you the long version or the short version. I don't have time to give you the long version, but we have a very thoughtful go-to-market plan. So let me start just the high level is what we'll do is some of these ADRCs, these are Alzheimer's disease research centers. There's about 50 of them, plus large memory centers and hospitals. Those will be where we have the halo effect from our clinical studies. Think of UCSF or Hopkins, right? Or Harvard, right? So they have the halo effect. Their experience informs these guys. These are the private practice guys. There's 225 large practices by our count that have over 6 neurologists on staff. These are highly entrepreneurial, early adopters who embrace new technology and really know how to make money, honestly, from it. So for example, some of these practices have bought their own $2 million MRIs because they know they can make that a profit center if they put enough patients through. Perfect candidates for our therapy. So with 40 reps, just 40 sales reps, we can hit all of these accounts. These are the largest ones. And then our third wave of go-to-market is the infusion centers. Why infusion centers? Because they're already seeing Alzheimer's patients who are being referred to infuse those drugs that barely work and can kill you. Yeah, they're seeing those patients and MS patients from neurologists. So why not give them our therapy and put it right next to a phlebotomist chair? The technician who administers the IV drugs is about the same level of sophistication as the technician needed to do our therapy. So it's a perfect match. We've talked to 3 of the nation's biggest, largest infusion providers, and they love this therapy because they can make more money on our therapy than they do even on the drugs. So that's the relatively short story, but I can go into a lot of detail in our thoughtful go-to-market plan. We've done our homework. I've sold capital equipment in 40 countries. Chris Thatcher built the market for TMS for depression. We have a very thoughtful go-to-market. That's just the high level.
Yeah. The next question is, what part of the Alzheimer's market are you aiming for? What's the ideal profile? Early stage, mid stage, late stage, different kinds of Alzheimer's? What are you seeing there?
So what's interesting is we started with mild to moderate. Now there's no drug approved for moderate, not a single drug. Why? Because those patients are usually thought of as too far gone to be able to be rescued. Every single drug has failed in moderate. We actually work in moderate. And so we also work in milder disease. So it's about 2.2 million in that sweet spot. The MMSE is a way to gauge Alzheimer's progression. It goes up to 30. So 30 is normal and 0 is no function. So 18 to 26 on the MMSE is our sweet spot. That's about 2.2 million patients in the US, but 4.8 million patients will be on label. So we're going to target those sweet spot patients first. But every doc we talk to says we'll start even earlier than your MMSE of 26. We'll go all the way up to MMSE of 30. Those are patients who have almost no cognitive impairment, who actually have Alzheimer's and know they're going to decline. They say they will treat them prophylactically. So there's going to be a lot of off-label use. That's why we're doing this early AD study too, Hall, is to make sure that we can also address those earlier patients. And that's why I say if we're successful there, we can double our LTV because patients will do many more years of therapy if we start them early enough.
Great. And that's the end of our time. Thanks so much, Ken, for a great presentation, a great Q&A. With that, let's move to our third presenter today, Nathan Monti of Enamel Pure. Nathan, if you can launch your slides and kick off when ready.
Good afternoon, Nathan Monti, co-founder and CEO of Enamel Pure. Enamel Pure is attacking the hygiene market. So the technology for the hygienist hasn't changed in over 50 years. We're introducing a new device, which couples a laser and a camera imaging in one package so that we can update all of the technology within preventive dentistry. Surprisingly, 160 million people get their teeth cleaned every year. The market's enormous. Teeth cleaning, fluoride, and whitening is $16 billion per year. That's from insurance companies and out of pocket. That's what was spent in 2021. There's a further $6 billion in clear aligner purchases. So the U.S. market, actual money spent every year is $22 billion, with the worldwide market being in excess of $50 billion. It's a surprisingly large market for an incredibly simple procedure, healthcare procedure, cleaning teeth. So the two parts of the system are the laser and the imaging. The laser cleans your teeth. The key here is we have developed a special optical pattern. Instead of having one focus spot coming out of the system, there's 75 focus spots about the size of a pencil eraser. That's what allows the hygienist to clean the teeth so quickly. We then use the same 75 spot pattern under different laser parameters to harden the enamel. The hardening replaces the inner office fluoride, the fluoride varnish it's referred to as. And then there's a whitening mouth guard. The whitening mouth guard is popped in after the cleaning and hardening procedures. And the patient drives home with a mouth guard in their mouth because there's a battery inside of it. On the imaging side, the imaging up in the top right-hand corner, the imaging camera looks down through the handpiece the same collinear with the laser beam. I show the laser beam in red, but it's actually invisible. So the camera can actually take pictures of the teeth while they're being cleaned. So 160 million Americans sit in the chair to have their teeth cleaned a year. So we do both update the clinical procedures as well as get a 3D full color image of their mouth at the same time. The system costs about $35K. That's very affordable for almost all dental offices in America. This is an easy slide for me. The present state of the technology is, noisy, rinsing, slow, bleeding, and they don't kill any bacteria, and they remove most but not all of the plaque. The diagnostics in oral health basically there's no computerized diagnostics. It's just a matter of the hygienist or the dentist looking at your teeth and gums and seeing what they detect. So how does our system work? Well, it's up to 2 times faster. A 50-minute dental cleaning appointment can be reduced to 30 minutes. It's quiet, it's non-contact. The patient loves it. The hygienist doesn't get carpal tunnel anymore. We completely remove the plaque, and we also kill the bacteria and the viruses on the teeth and under the gums. The laser hardening, we refer to it as purification. The laser hardening of the enamel is up to 10 times harder. It actually works really well, far superior to the fluoride varnishes. And then the whitening is a convenience model. You pop the mouth guard in, there's a battery there so the patient can drive home. Again, we do the cleaning and the imaging at the same time, and then the patient doesn't have to stay in the office for their whitening. So the whole process here is to get the patient in and out of the chair and get the clinical events billed. So on the imaging side, we're creating the largest dental image data set ever. So the imaging is a camera, it's digital, it's 2D and 3D, and we can convert it to a measurement file called an STL file to define clear aligners. So how it works is when you sit in the chair every 6 months or every year, you get your teeth cleaned. And while you get your teeth cleaned, they're imaged as well. So longitudinally or over time, the AI compares those images. And from that, we can find cracked teeth or night grinding. Right now, nobody has any idea what average gum recession is. So we'll be able to define average gum recession over time, and nobody has any idea what average enamel loss is, enamel erosion. We'll be able to define that for people over time. An eight-year-old child might go to have their permanent teeth come in, so they go to have the teeth cleaned. By the time they're a teenager, we've got 10 or 12 or 13 different scans. We can put those all together, convert them into a measurement file, and now the clear aligners are defined for the child, including how the teeth came in, so we can straighten them better than you can just taking an initial scan when they're older. So the product roadmap, the clinical procedures are done. This year, we're doing the camera for the imaging. Next year, we'll be doing the integration with the AI and launching that 2 years from now. And then in 2027, we'll start the reconciliation of the oral health records from our database to general health, to connect the dots between oral health and decay and bacteria in the mouth to brain health and heart health. So we have a very large market, 16 billion plus clear aligners to 22 billion. We have a real need to going to the dentist and hygienist is one of the top 5 anxieties in America. So how do we get this to market? So we've signed 3 distributors. Over 95% of the dental offices in America are serviced by 3 distributors. We've signed Henry Schein, the largest distributor in the world. We've signed Benco, which is the 3rd largest in America. And we've also signed Medicend Partners, who targets the large conglomerates, the Aspen Dentals and Heartland Dentals and Pacific Dentals. So that's a more targeted measure, messaging, so we can get to that large portion. The conglomerates are about 25% of the market at this point, and 75% is the mom and pops. And then we do all the sales and services done in-house. We have nobody in the field, and then all the equipment is manufactured from components from Asia. It's assembled and shipped from Newburyport, Massachusetts, and it goes right directly to the dental office. Enamelpure never sees the product. So then I'll go a little bit more quickly now. So the product itself, we just make the device, and then we do the software, the imaging, and the measurement files. Our partners do everything else, the sales, the AI software, the clear aligner manufacturing. The reason we do that way is so we can integrate more quickly into the market. And our system sits next to the hygiene chair, and it Wi-Fi's to the central practice management system you see. We get a number for the patient. We attach it to our 3D model, our image and data sets, and then we Wi-Fi it up to the practice management system. We never know who the patient is. We only know numbers. We compare the numbers from visit to visit. We don't have any HIPAA requirements. The practice management system does all the AI processing up on the cloud, and they also do all the interaction with the dentist. So we do contract manufacturing. We have no direct competition. We only have the mechanical tools as our competition. My business partner is a patent lawyer. We've filed 23 patents and 7 are issued so far. How do we make money? The capital equipment, we make about 50% selling the equipment, but the real money's made with the recurring revenue. We charge $2 per cleaning. There's 160 million a year. And we charge $3 for a hardening or a purification. That's what the existing fluoride varnish costs. So we're just replacing that cost in the dental office. And then the whitening is we charge for the mouth guard in the hydrogen peroxide, somewhere around $30 or $35. The monetized data, as we roll it out in 2027, we'll be charging to upload the imaging, which can be AI processed for the first ever computerized diagnostics to create an annual oral health report for everybody in America. And then the measurement files, we charge for those when we send them to the clear aligner manufacturers. So I'm Nathan Monte, co-founder and CEO. I started a company called Light Laser. We sold that to Videojet Technologies, owned by Danaher Corporation. I then started Convergent Dental, which is another laser for drilling cavities in the dental space. That's at about 25 million in sales, about 100 people over in Waltham, Massachusetts. They're hoping to float that next year. And my business partner is a patent lawyer, as well as a previous engineer, where he did a lot of laser medical device and imaging stuff, mostly in skin resurfacing. And then we have all the traditional backup support. Skip the patent slide. So where we are, we got our FDA clearance, 510(k) in March. We're producing the first 10 units at the moment. A couple are done. We did our first patients. I was the first one. We did our first 2 patients over the last 3 weeks. And now we're rolling out the units ourselves so we can give them to key opinion leaders around the industry. And we hope to have sales start in April and May of this timeframe. We do have a few pre-order sales, but not too many at the moment. We have about 12 to start. And the ask, we have a super seed going. It's $1.5 million raise. I have 250K left in that $1.5 million. And that's at an 8 million pre. So once that's done, then we'll just wait till June, July, August this year when we have revenue and sales, and we'll do a big raise at 32 million pre, 8 million raise, 40 post, and that's to fund all the inventory and all the rollout of the sales. So thank you very much for your time. If you have any questions, I'd be pleased to take them.
Great presentation, Nathan. Jim, what's your first question?
Nathan, great presentation. Hey, I'm trying to judge the take rate to make sure I understand your revenue projections. At the office level, what do the financials look like? If I'm a dentist or a large, like a Aspen or something, why do I want to bring them in? What's in it for them?
Well, there's a couple good question, Jim. There's a couple of things. First of all, in 2020, when the dental offices were literally shut down across America. A lot of hygienists went home. They found other ways to make money before they were called back to the dental office, and about 20% of the hygienists never came back. And that we have a shortage of hygienists to this day because the community colleges and the state colleges can't ramp up to produce a whole lot more to fill in that gap. So at the moment, when we roll out our product being almost twice as fast as the present appointments, there's a lack of hygienists. That's why we have such a tremendous interest from the conglomerates, but also just by being able to process more patients, and also by doing the cleaning, the hardening, and the whitening all in a 15-minute span. We're doubling the amount of billings that the office can have in the same time frame. So it's really a model where we're making their life a whole lot better. Patient retention goes up, the hygienists love it, and they're able to bill a lot more. So that's how it works. It's a little bit of everything. And of course, once we roll out the AI oral health report, annual oral health report, that leads to all kinds of billing possibilities that never existed before. Having computerized diagnostics in oral health will, completely remake the whole industry.
Yeah, agreed. So it sounds like the model then is it sounds like maybe it's flat to cost of what they're doing now, but the idea is to be able to operate with less headcount as well as more efficiency, more throughput. Is that fair?
Yeah, that's correct. Yep.
Perfect. Okay, cool. Thank you. Appreciate it.
Great. Can you talk more about the AI opportunity there? Where do you see it going, and what exactly can it do for you once you have the data?
Yeah, so the AI opportunity, thanks, Paul. The AI opportunity is kind of like having a lipid panel every year. So you'll have an AI oral health report every year, and you'll have a 1 to 10 on like what's your gum recession, what's your enamel erosion, what are you night grinding, all these, or do you have an overbite, so on and so forth. Do you have a cracked tooth? There's just a large number of oral health issues that the dentists and the hygienists just can't see. They can't foresee or diagnose. They have to wait until there's a problem and then they treat it. So the idea here is to get out in front of it. So if you're in your 20s or your 30s and you're told that, look, genetically, your teeth erode a lot more because you don't salivate as much, or your gums are receding at a greater rate, that'll drive people to spend more on their oral health. If people can see on the practice management system they do have a pending issue, they'll take care of their teeth. It's proven over and over again. If you can show people how to take care of your teeth, like straightening your teeth with clear aligners or braces, people pay to straighten their teeth. So if you just show people the enamel loss or the gum recession or the cracked tooth or whatever, that leads to a lot more visits and a lot more revenue for everybody involved, and more revenue for us because we get paid every time the scan or the measurement file gets uploaded. Does that answer your question, Hall?
Yes, it did. It's great. Great opportunity there. Thanks so much for the presentation. That's the end of our time. And with that, let's move to our next section here today. We're going to talk with Jim Mills. Jim, can you tell us more about yourself and your background? You're on mute.
Sorry about that. You'd think I'd be used to that by now. Thanks, Hall, and thanks again for all the presentations. Gosh, I really enjoy getting to see all the great stuff that you guys are bringing to market. So thank you for the presentations. So my career was spent in retail and wireless. For the old school folks on the line, I started out with Radio Shack as an executive there for many years, and the last decade or so I spent in the wireless industry with Vonage, Sprint, and most recently T-Mobile as an executive there. I did a semi-retirement a couple of years ago, and I'm really embarking on more of a portfolio career nowadays. So I'm doing some advising with some retail-centric companies, some wireless-centric companies. I'm doing some board work, both nonprofit and for-profit. And most recently, I've started, and it wasn't something I planned on starting, but I started doing some pretty heavy-duty fundraising in the nonprofit sector. So the learning curve is going straight up at this point on that particular part of what I'm doing. But happy to be here, and Hall, as always, thank you for having me.
Great. Thanks for joining us today, and looking forward to your feedback for these deals later as well. So with that, let's go to our next section. We were talking about term deals with 10 Capital. Let me go and put my slides up here to show you guys what we have going on. And what we're trying to do is talk about how do you go and um, what are the different deal structures that are out there. We see a lot in this direction right now. And so with that, let me share my screen, which is right here. Right here, and move these out of the way. And we just have a short presentation that I want to walk through with for people that are not familiar with this area. And what we have are the 10 deal terms to understand and the term sheets that go with them. So with that, let's go ahead and kick into the actual slides itself. Let's see. There it went. So if you look at the NVCA website, there are over 125 terms to know. And what you'll find is that there's about 10 of them that you really need to know very well. You don't need to know all 125. I will say the reason there are so many is that for every risk in the deal, there is a term in the term sheet to mitigate it. So if you feel like you're not having the right thing in the term sheets for you, think about looking through for the terms that might help you balance it out. For example, if you think the valuation is too high, think about putting a liquidation preference in to balance that out. And you'll find that there's many resources that aren't used very often, but they are available to you if you need them. Um, so let's first talk about term sheet structures. The standard has always been equity. That's when we price the round, we set the price per share, and everything is built on top of that. Typically, the valuation is agreed upon by the investor and the startup, and we're using what's called the pre-money valuation. And just so people know, pre-money plus investment equals post-money, and the investor gets the investment divided by post-money. So if you have $4 million pre-money valuation, you're raising $1 million. Post-money is 5. The investor gets $1 million investment divided by 5. You get 20% of the company. That's why the investors looking to see how we can get the valuation down, and the startups looking to see how they get the valuation up. And in the end, it's less a formula and more of a negotiation when you go into it. The second is what's called SAFE, Simple Agreement for Future Equity. It's the right to buy stock at a later thing. And instead of having a valuation, what we have is a valuation cap. It won't be much more than that. Always coach people, if they're an investor, make sure that there is a valuation cap on there so you have some comfort about where the valuation may come out at the end of the day. The two things to know about SAFE is one is there's something called a post-money SAFE and there's a pre-money SAFE. If you don't see any of those wording up there, you're looking at a pre-money SAFE. And the issue with the pre-money SAFE is if the founder raises more than what we thought they were going to raise, the investor will be diluted. If you have a post-money SAFE, well, then we're going to calculate ownership based on the post-money. Doesn't matter how much they raise, and so you can lock in your value if you actually use a post-money SAFE. The other thing to look for in a SAFE note is the conversion. The drawback to a SAFE note is that they often don't convert to equity, and you have a technical challenge there. You have to figure out how to get it to convert to equity so you're in the deal. And they normally convert when there's a follow-on round of funding. Well, if there's no follow-on round of funding, how is that going to convert? So the next SAFE note you look at that doesn't have a conversion metric on it, like a maturity date, for example, think about trying to add one of those in there as well. The third one is the convertible note over in the left-hand corner. It's a debt instrument that converts to equity later, and it usually matures on two factors. One, it converts when it hits the maturity date. Those are typically at year 3 or year 5. Or two, if there's a qualified pricing round afterwards, at which point it will convert over. Again, we're using a valuation cap to set the valuation if there's no other price round coming in that's below it. It'll come in at the valuation cap when it matures. There's also an interest rate and a discount rate that goes with it. And those are not ever distributed. It just converts more equity into the deal for the investor when it goes over. The next is what's called KISS. It's a keep it simple security instrument, which gives the investor the right to buy shares in a future round. And this often comes up where people want to get access to follow-on rounds of funding as they come through. Next is something that most people have not heard of, but is becoming increasingly popular, called SEAL, Shared Earnings Agreement. The goal the goal of the term sheet is to align the founder and the investor on the same path. And obviously, the founders are most often in the early days very interested in taking home a salary. And so, one mechanism is, instead of pricing the equity, just get a percent of what the founder's taking home. If you can get that, you know that there's complete alignment. They want more salaries they can get, and you want to be on the same plan that they're on. So with that, you can actually make a good return. You don't own equity, you just own a right to the future revenue that comes out, and it'll be paid out at the rate of salary that's being paid to the team. The third one is revenue-based funding. And I've done this before. It basically gives the investor a piece of the revenue going forward, and it pays back the investor at the rate of revenue. This is typically in the 2 to 3% range, sometimes up to 5, but that's pretty rare. And basically, you're looking for what's called a payback rate. If I put in X number of dollars, how much will I get paid out at the end of the time frame? And usually they put a 5-year window on it. And typically it's in the 2 to 3x. I put in 100K, I'm expected to get 2 to 300K out of it over the next 5 years itself. And so that's the payback cap is 2 or 3x, and then the payback rate is what percent of revenue are you getting? Are you getting 2% or 3%? There's typically a definition of revenue, and it's usually paid out monthly or quarterly. What you'll find with revenue-based funding is that often the firms that are involved with this is they gain access to the QuickBooks and the bank account, and they're able to pull the money out directly, and they're able to get their own reports as they go forward. This increased transparency really helps with the investor and the founder relationship for sure. The last one, and we want to talk a little bit about more, is called the 3X and 3. And basically, it's a convertible note that at year 3 gives the investor, at their in sole discretion, redemption right for 3X their investment. So if they put in 25K at year 3, they get the option to convert to 75K. And then they get to go on a revenue share agreement, 2 to 3% of top line revenue or other, to pay them back out. And the issue is coming up that only it used to be that 50% of the startups that raise a seed fund would go on to raise a Series A. Today, that number's down to 24%. Only 1 out of 4 are able to raise a follow-on Series A round after a seed round. So many companies are not continuing up on the equity curve. They're now going sideways. And what we find is that many companies go into the payroll exit when they get into that mode. And the way to solve that as an investor is to join them on the payroll and convert to a revenue share agreement and just get paid out just like the founder's getting paid out. So it's a great way to maintain alignment with the founder over time. Again, you have a 3-year window before you have to make that decision, but usually that's about when it becomes clear which way the company is going. It's continuing to grow or is now moving sideways. Again, you're using all the usual terms in a convertible note, such as the valuation cap, interest rate, discount rate. Most everything else is the same as well. If there's any questions, please let me know. Should get the chat box back up here in a moment to look at this. But let's look at some of the other things that we can use. So how do you know which one of these term sheets to use? Well, in the very early stage, you often see safe notes, convertible notes, and KISS, because at the very early stage, it's hard to set valuation. There's not enough revenue there. There's not enough metrics to really figure out what the valuation should be. And so people just put money in on these notes with the idea that we'll set it later. And so one of the things you want to ask about is to determine which one to use is, number one, what is your valuation? If you can gain agreement between the investor and the founder, you can go ahead and put a priced round on it, because ultimately everybody wants to move to a priced round. Second, look at your exit. If you, as a founder, don't plan to sell the business or you want to keep it for a long time, then you may want to think about some of these other tools like revenue-based funding or 3X and 3 or SEAL, because it's not based on equity. You can actually pay them back out and maintain a position in the company. And there are some that come and say, I don't plan to ever sell the business. What do I do? Well, use one of these other mechanisms like revenue-based funding or 3X and 3 in order to figure that out. So if you look at revenue-based funding, what you'll find is that it makes a startup investment and it pays back the investor at top line revenue. Some people think this is bottom line. No, it's top line revenue. And if there's any revenue at all, the investor is first in line to get a piece of that revenue. And so the higher the sales, the faster the payback rate. So everyone's motivated to increase sales. And that's a great alignment if the founder and the investor are both on the same plan. And it works really well with recurring revenues and healthy margins. One thing I found in doing this is that you really need to have at least a 40 to 50% gross margin, and you need to have an annual growth rate of at least 20%. If you're in that game, you can do it. The rule of thumb for revenue-based funding is you can raise up to 1/4 of your revenue. So if I have $1 million of revenue, I can raise up to $250K easily with revenue-based funding. The other one is seal-based funding, as we talked about before, is really about making it salary-based funding. So as the founders want to increase their salary and the business can continue to grow and thrive, well, we want to be right there along with them, taking the same a percent of what they're doing as well. And so this works well when it's not clear if additional funding is available or will be required. And so if they don't have to raise any more funding, but they can cash flow it out, this may be a good way to structure it. And then the last one is the 3X and 3 solution. And we talked about this before, where it's like revenue-based funding, but it gives you 3 years to start. It's different in that if I take a revenue-based funding loan today, in 30 days, I have to start paying it back. And revenue-based funding by itself really works well with a complementary equity round because the equity will be in there for the long haul. It gives you good working capital. Revenue-based funding is good for just the operations. And 3X and 3 gives the entrepreneur the opportunity for 3 years. They get to use that money to grow their business and take it up. But at the end of year 3, people can make a decision as to which way they go. And you'll find as done about a dozen of these deals, all but one worked out great. One that didn't work out great went bankrupt. And that is one thing about all these term sheets is if the company goes bankrupt, there's nothing that can save you. It just goes away. But with 3X and 3, they were able to maintain alignment with the founder in whatever way they were going with it. And so it's really good for defining the exit for the investor. One of the challenges investors have today is that they're in these equity deals and companies are staying private so much longer. They're not exiting out as fast as they once did. In the angel world, they had a saying, and angel investors want 3 to 5 times their money in 3 to 5 years. Been a long time since we had exits in the 3 to 5 year range. They're going to 7, 9, 10 years, sometimes longer. And investors really just don't want to stay in that long. And when you're not quite sure which way it's going to go, maybe a 3X and 3 is a good option to help you define the exit for where you want to go. So let's talk about a few key terms, and then we'll take questions and then move to breakout rooms. Number one, valuation is the price you pay for equity. It's what the company is worth, and in the end, it's more of a negotiation than it is a formula. There are good formulas out there to help you figure out what it might be, but in the end, it must be agreed upon. I will tell you, as a return goes, this is the number one thing that really determines what kind of return you will get. We can look at interest rate on the convertible note. We can look at discount and so forth. These are minuscule compared to the impact of what valuation you get set on the deal itself. Next is participation rights. It's the right to investors to get into future rounds. If people want to maintain their position, they want participation rights in order to keep the equity ownership that they have there. Most startup investors invest a small amount in the seed level, and then they invest a lot more at the Series A level when they know it's going to go somewhere. And so it's important to maintain your position in these successful startups. Next is drag along and protected positions. These are basically drag along rights, give the investor the right to force the shareholders to sell the startup if there's an offer out on the table. And drag along rights are common in VC deals as well. And so they just help move the company to an exit if one is available for them. There's also pro rata rights. This gives the investor the ability to maintain their ownership level in the company. So if they want to own X%, they get the right to invest to keep that going all the way throughout the process. And next is board and information rights. This is one of the key rights that you want to look for in a term sheet, any term sheet, is that you have the right to have the financial documents and others. It's best to state out what you mean by information rights. And if you want to have a say in the company, you should get a board right as well. You may be having to do some work for it, but you can stay operationally involved with it through the board itself. Next is liquidation preference. This basically says you get your investment back first. If it's 1x, you get 2 times your investment back if it's a 2x liquidation preference. And then the remainder goes to all the investors pro rata. And this is where people come in with these when they feel like the valuation is too high. Well, I'll just take a liquidation preference to balance that out. And next is redemption rights. Redemption rights typically came at year 5, and they gave the investor the right to demand their investment back if the deal is not going anywhere. Well, we came up with a 3x and 3. We said we really don't want to just wait till year 5 and get our money back. We really want to wait till year 3 instead of 5, because that's when we start to figure out which way it's going. And we really want a gain because we came here to put money in on a gain itself. So redemption right gives the investor the right to sell their shares back to the company if they want to exit before an acquisition. The other term you'll find is unvesting founder shares. Well, you'll find when investors put money in, they want the team to stay through the process. This is typically a 3 to 4 year window to accomplish the initial work that they're supposed to do. And for founders who already have shares, they will sometimes unvest those shares and bring them back and let them re-earn them back. And the purpose of this is if you're signing up for a 4-year commitment and you leave halfway through, we can take the extra shares that are left over and put it to the one that's going to go take their place. And so it protects the investor from someone leaving with equity. I talked to a lot of startups where half the equity is already gone because one of the co-founders left and they took the equity with them. They weren't vesting those shares, and that's always important to invest shares, whatever you have. But if you're taking money, you'll find you may have to put up some shares for vesting purposes to carry it forward. And next is pre-money valuation. This is the value of the company before money goes in. This is the negotiating factor that always comes into these discussions with the founder and the startup. And so it sometimes is calculated as a price per share, but that's only if it's actually been an equity arrangement. So with that, if you have any questions about that, feel free to meet me in the breakout rooms. Let's go back to our slide presentation here. Let me see how I get out of this. Here we go. And we'll go back into our session. And for those who want to go into breakout rooms, Kat can help us move into that as well. Thank you guys for joining us today. When you're finished with the breakout rooms, we'll look forward to seeing you guys next time. And with that, thank you so much for joining. I want to thank all of our presenters. And again, I want to thank Jim Mills for joining us here as well. Thanks for joining, Jim, and looking forward to seeing you in the breakout rooms if you have a moment. Thanks so much.